Hi there, I'm Darren McDermott and you're watching Dukascopy TV for an economic update on China. Now, Chinese inflation grew at the fastest pace in 4 months. I'm joined by Ed Jones, Chief Executive at World Economics. So Ed, do you think low inflationary pressure gives room for further reserve ratio cuts over the coming months?
Official statistics and data from the OECD has shown inflation rising at a very consistent pace over the past 3 years. There will inevitably be months where the pace of inflation varies, but on the whole, it has been very stable. Our World Economic surveys for the SMI and World Price Index are showing that prices in April did spike, but very marginally, and may have seen these figures ease back to consistent levels. The outlier in April could have been caused by seasonal factors, but our data is showing that the increase was mainly driven by the manufacturing sector rather than services, which indicates input costs may have played an active role. When you take a more holistic view of the economy, where manufacturing quotes for just 32% of GDP, according to the World Bank in 2010, you can see that the impact of monthly variations are minimal. What we have found in our SMI research, though, is that in May, 28% of respondents to our panel of sales managers believed that the valuation of the renminbi is negatively affecting their business. On the whole, businesses are cautious about marking up prices on the back of a strong market growth to try and maintain a competitive edge. This is from a business perspective, but inflation has a real impact on the population as a whole of any country. Our World Price Index analysis suggests that the Chinese renminbi is 6% undervalued against the US dollar, which is helping keep exports competitive, but also keep the cost of everyday goods and services at acceptable levels for consumers. Trade data released at the weekend signals that there was a $36 billion trade surplus in May, which is the biggest monthly surplus in 5 years, and Chinese exports rose 7% year on year, while imports have fallen 1.6%, which suggests that there are maybe weaknesses in the domestic economy which China's central bank is mindful of. This can be seen by the current guidance in the official exchange rate. It will be interesting to keep a note on these actions by the central bank over the coming months to see any positive impact materialise.
And Ed, we saw a recent rise in business confidence. Now, this is the 9th consecutive monthly increase, showing economic optimism is on the rise. So do you think we will continue to see more of this?
Certainly. Our future business confidence data is a forward-looking indicator to gauge overall market growth. It's been growing steadily from August last year and is currently at 61.8, which suggests a really good feeling that things will continue to get even better for businesses. The Business Sentiment acts as a leading indicator for general market growth, which has been steadily picking up pace since August also. I would expect this trend to continue for the next few months at least. It's also worth noting at this point there's been an upturn in the number of consumers expressing the opinion that the economy will continue to be stronger in 6 months' time also.
And Ed, sales growth remains high, so what are the driving factors?
General market growth coupled with stable prices being charged up for products is driving monthly sales growth. This in turn is leading to increased business optimism, which is then translated back into strong sales targets. When you look at individual sections of the economy, you can see that retail sales, although plateaued a little recently, are still very strong. Year-on-year car sales are up by 11.6%, and more industrial indicators such as cement production and steel production have continued to be strong for the past few months. All in all, China is still growing at a very strong and solid pace. Our data is consistent with GDP growth rate of around 7.5% for the year, which is the official target set by Premier Li Qiang in March.
Ed, thank you very much. Well, viewers, do not go anywhere. Do stay tuned as you have plenty more just like this heading your way. Goodbye for now.